A portion of that money inevitably seeks the highest growth, highest potential return opportunities on the planet. In the modern era, that search leads directly to digital assets. The 2020-2021 bull run was, in large part, a product of unprecedented pandemic-era liquidity. The market is now positioning for the opening chapter of a new liquidity cycle. Therefore, the recent bounce in Bitcoin above $89,000 and Ethereum's 6% surge are not isolated technical recoveries. They are the direct real-time price discovery mechanism responding to this changed macro reality. The rally is a bet, a multi-billion-dollar bet that the Fed's hand is being forced. It is a bet that the dam of restrictive policy is about to crack, releasing a wave of capital that has been sitting on the sidelines in money market funds, earning 5% interest. This pivot is the primary catalyst because it changes the fundamental valuation model for all speculative assets. A lower discount rate in the future makes their potential cash flows, or, in crypto's case, utility and adoption, more valuable today. It lowers the opportunity cost of holding a non-yielding asset like Bitcoin. It encourages leverage and risk-taking. In essence, the Fed is not just adjusting a rate, it is flipping a psychological switch for the entire investor class from capital preservation back to capital appreciation. And in that environment, crypto doesn't just participate, it often leads. The current price action is the first loud signal that the market hears the switch flipping. The weeks ahead will be about whether the Fed confirms what the market already believed. In the sophisticated arena of global asset allocation, value is not an absolute measure, but a relative one. It is determined by comparing one opportunity against a universe of alternatives, weighing potential returns against inherent risks, and assessing future growth against present cost. For the majority of 2023 and 2024, the narrative of value was monopolized by the artificial intelligence revolution, with a handful of technology titans, collectively dubbed the Magnificent Seven, commanding trillions in market capitalization on the promise of a transformative future. This concentrated trade became the gravitational center of the market, sucking capital, attention, and speculative energy into stocks like Nvidia, Microsoft, and Meta. However, the very nature of a crowded singular narrative is that it eventually becomes strained. We are now witnessing the early tremors of that strain. The AI trade is showing pronounced signs of fatigue and fundamental concern. Nvidia, the undisputed kingpin of the AI hardware boom, recently experienced a sharp post-earnings decline. This wasn't due to missing numbers. They crushed expectations, but because of a more nuanced and troubling pattern emerging in its business model, the practice of vendor finance. The revelation that Nvidia is increasingly lending money to its own customers so they can purchase its immensely expensive chips echoes dangerous precedents from the dot-com bubble. It raises the specter of artificial demand channel stuffing and a potential debt-fueled house of cards. This is not just a yay Nvidia problem. It is a contagion of doubt that questions the sustainability of the entire AI infrastructure spend. When a sector's growth appears dependent on financing its own demand, savvy investors begin to reevaluate the underlying health of that growth story. Concurrently, the drawdowns from all-time highs across this superstar cohort are becoming impossible to ignore. Apple is down. Google is down, Tesla is in a bear market. These are not minor corrections, but significant retreats of 15%, 20%, 25% or more. This collective weakness signals a macro rotation, a recalibration of risk appetite away from the most crowded and extended trade. It is against this backdrop of a wobbling tech hegemony that the cryptocurrency market presents a compelling and arguably overlooked case for relative value. To understand this, we must examine the depth of the drawdowns. While Microsoft is down 15% from its peak and Nvidia is down 16%, the figures in the cryptosphere are of a different magnitude entirely. Bitcoin, the flagship digital asset and increasingly recognized digital gold, is down approximately 33% from its all-time high. Ethereum, the foundational platform for decentralized finance and the next-generation internet, is down a staggering 45%. Major crypto-related equities like Coinbase are down a similar 46%. These percentages are not just numbers. They represent a massive compression in valuation from the euphoric peaks of the previous cycle. They represent assets that have already undergone a severe and protracted bear market, purging much of the speculative excess and leverage that characterize their tops. From a technical and psychological perspective, crypto assets have already endured their crash, while parts of the traditional tech sector may just be beginning theirs. This creates a powerful asymmetry. An investor looking at the landscape sees, on one side, the AI darlings trading at historically high price-to-earnings multiples based on projections decades into the future, now showing technical and fundamental cracks. On the other side, they see foundational crypto networks with established, growing global utility, store of value, decentralized computation, digital ownership, trading at a 33–50% discount to their prior highs, with adoption metrics, active addresses, transaction volume, institutional custody inflows that continue to trend upward secularly. The term relative value play crystallizes here. It does not mean crypto is cheap in a traditional accounting sense, as it lacks conventional cash flows. It means that relative to other high-growth, high-risk, technology-focused asset classes, crypto offers a more attractive risk-reward profile at current levels. The downside in the tech giants from current levels could be a prolonged bear market if AI expectations are not met. The downside in Bitcoin and Ethereum from levels already 30–45% below their highs may be more limited, especially if the macro liquidity tide, as per Keynote 1, is turning in their favor. Conversely, the upside potential for crypto in a new liquidity cycle, given its higher volatility and beta to risk sentiment, could dramatically outpace a mature trillion-dollar tech stock. Furthermore, crypto's value proposition is diverging and becoming more nuanced. Bitcoin is cementing its role as a sovereign, non-debt-based hedge against monetary devaluation, a narrative only strengthened by reckless fiscal policies and expanding government debts globally. Ethereum and other smart contract platforms are building a parallel financial and digital infrastructure. Their earnings are not corporate profits, but network security fees and the economic activity they enable. This isn't competing directly with NVIDIA GPU, it's building a different kind of future altogether. In essence, the capital markets are a vast comparative engine. When one premier growth narrative, AI tech stocks, becomes expensive, extended, and fraught with new questions, the engine naturally scans for alternative growth narratives that have been oversold or overlooked. The crypto market, having been left for dead by many mainstream commentators after its brutal 2022, now sits with stronger fundamentals, clearer regulatory pathways, with ETF approvals and institutional custody solutions, and massively compressed prices. It represents a fresh slate for capital rotation. The recent concurrent weakness in tech and strength in crypto is not a coincidence. It is the early stage mechanics of this relative value trade playing out in real time. Similarly, the regulatory approval for prediction markets like Polymarket to operate in the U.S. directly embeds speculation on events like the Fed decision into the financial ecosystem itself. The odds on these platforms become a reflexive newsfeed, influencing trader psychology and creating self-fulfilling feedback loops. When the market can bet on its own sentiment in real time, volatility becomes recursive. In this maelstrom, traditional leading indicators can falter. This is why the market has seized upon an unconventional but increasingly critical canary in the coal mine, MicroStrategy MSTR. The company is no longer merely a software firm. It is a publicly traded, leveraged Bitcoin ETF in corporate form. Its stock price, therefore, acts as a pure-play sentiment gauge and liquidity proxy for institutional and sophisticated retail appetite for Bitcoin exposure. Its recent performance, down over 69% from its high, is a deafening alarm bell. It tells us that the leveraged, institutional-facing conduit for Bitcoin demand is under severe stress. Because MSTR often moves before Bitcoin itself, its stock is a claim on future Bitcoin value and is traded by equity investors with different margin and risk models. It serves as a leading indicator. Its persistent weakness, even amidst a Bitcoin rally, suggests the smart money using this vehicle remains skeptical or distressed, a stark divergence that must resolve. Watching MSTR is not about analyzing a business. It's about monitoring the pressure gauge on the institutional Bitcoin boiler. A failure to rally with Bitcoin signals deep-seated doubts. A sudden surge could signal the floodgates of institutional re-entry are opening. Thus, the mandate for the investor is not to seek a smooth path, but to navigate turbulent skies. The strategy shifts from set and forget to tactical awareness. This means smaller position sizes to withstand violent downdrafts without being stopped out. It means having dry powder ready not for a distant future, but for the liquidity moments of extreme fear that will inevitably punctuate the next 10 days. It means understanding that headline-driven minute swings will be emotionally charged and largely noise, but that the overarching trend will be set by the Fed's confirmation or denial of the market's bold. Volatility is not the enemy to be avoided. It is the environment to be understood. It is the market's mechanism for pricing reality against expectation. In the coming days, we will witness a high-stakes drama where monetary policy, political ambition, year-end mechanics, and speculative innovation all collide. The outcome will be a series of sharp, decisive moves that will lay the groundwork for 2025. The normal of steady, low volatility growth is suspended. Until the Fed speaks and the market digests the true meaning of its words, we must strap in. The new normal is turbulence, and the only confirmation that will end it is a clarity so resounding it dissolves the crowded trade and establishes a new, stable, if different, consensus. Until then, the market will breathe in and out with volatile, panicked rhythm.